So it would be my expectation that the markets finish the year strong, like they typically do. However, if you look at what happens the following year, and this would be 2014, 2018, and 2020, and then also 2022. So the year following those strong years over the last 20 years, the average peak to trough decline that following year was 21.4%. I'd certainly look to brace for some volatility as we head into the next year or two.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. It's certainly an interesting time in the markets. The world's major central banks have returned to cutting interest rates, yet bond yields are rising on the long end. Meanwhile, risk-on assets are in rally mode. Stocks are back at all-time highs, yet so is gold, the granddaddy of risk-off assets. To make sense of all this, we're fortunate to speak today with capital managers David Hay and Jeff Dick of Evergreen Gavekal. David is its Chief Investment Officer and Principal, and Jeff is a Managing Director and Partner there. Gentlemen, thanks so much for joining us today.
Thank you, Adam. It's a privilege to be back, and very much my pleasure to introduce you to Jeff for the first time.
Thank you, Adam. It's great to be here. I've been a consumer of your content for a long time, and I've always appreciated your perspective, so it's great to be here.
Well, thanks. Very kind of you. Very happy to have you here. David has spoken very highly of you. Big fan myself of what you guys do at Evergreen Gavekal. As you likely know, I had your partner Louis Gav on the channel just a few weeks back. Got a lot of great feedback from Louis' outlook, and really looking to complement that with your guys's in this discussion here. If you don't mind, gentlemen, I'd like to start with the broad question, the intentionally broad question I like to kick these discussions off with. And Jeff, since you're new, why don't we let you take the baton here at the start? What's your current assessment of the global economy and financial markets?
Great question, Adam. Let me share my screen here. Can you see this chart?
Yeah, and look, you're already winning your way to my heart by coming prepared with charts. So thank you.
Yeah, I run a chart book every quarter, so we just released this. I pulled some of my favorite charts from this quarter's edition. So the first one, and on the economy, I think it looks right now like a soft landing or a no landing, and maybe even the latter, a no landing. The first chart is the ISM Services PMI, which this segment of the economy is over 3/4 of GDP. The services PMI is at 54.9. But more importantly, or as importantly, the new orders index of this ISM services index is at a 19-month high. So certainly heading upwards. You can see the last three recessions, new orders was deeply negative or under 50, as was the services PMI index. Also, you have retail sales hitting an all-time high. Net worth is hitting an all-time high. You almost never have a recession when these two measures are hitting cycle highs. Also, real wages have been positive for 17 straight months. So here you can see that the CPI is running at 2.4% year over year, and you have average hourly earnings running at around 4%. This red-green histograms just showing whether wages are tracking higher year over year relative to inflation. So in other words, consumers are earning more than prices are going up. And then also this one is really, I think, important for the inflation component and forward-looking interest rates. But this essentially shows CPI ex shelter running at 1%. And then you have owner's equivalent rent, which is the largest component of consumer prices, running at plus 5.2%. And what's interesting is if you look at the BLS and the Cleveland Fed put out a new tenant rent index, which is also running at 1%. And that metric tends to lead the OER, the owner's equivalent rent, which would indicate, and you look back in 2020, you had the new tenant rent year over year lead the CPI, and you had that happen as well in 2009, which would point to that OER continuing to come down, and overall inflation, in my viewpoint, at least over the next 6 to 12 months, continuing to head lower. And that will give the Fed cover to continue to cut rates. Of course, we saw the 50 basis point cut last month. And this is just a forward-looking expectation for the Fed funds rate. Another 6 cuts or 2 full percent from the peak is now baked in to the next 12 months. So that's certainly going to be supportive as well. And then along those lines, you have financial conditions that are continuing to ease. We were really restrictive as you saw the Fed raise rates. Lending was also restrictive. But over the last several months or even couple of years, you've had financial conditions start to ease and they're trending lower. This is the Federal Reserve, 2 Federal Reserve financial condition indexes, and these are moving lower and they're moving lower at a fast clip. Additionally,
sorry, just to be clear, you're saying that financial conditions have been easing and you continue to expect them to get even easier.
Correct. If I
Got it.
misspoke there, thank you, Adam. And then what you can see is not only in the US are we seeing lower interest rates and forward-looking interest rates going down, but you have that in the Eurozone, Canada, UK, Australia, China's starting to ease as well. So when you think about the interest rate landscape for the global economy, you're essentially seeing a series of interest rate projected cuts across the board with that, which should be supportive of overall global growth as well. And then the biggie, in my opinion, is just the US spending. And I think that's a big reason why we haven't had a recession over the last 18 months is you're running a 6.5% budget deficit. And what you can see here on the left is the historical budget deficit. Previous recessions, that was traditionally 2 to 3% of GDP, and we're not even in a recession, and we're at 6.5% of GDP. And then if you look at the forward-looking estimates on the budget deficit, these have worsened over the last 3 months heading into the election, but we're at over 6% estimated deficits for the next 3 years. So regardless of who wins the presidency, we know there's going to be spending. This is going to be a huge impact to the economy. And we can talk about the negative repercussions of this, but on a near-term basis, it's going to be positive for US growth and likely global growth as well. And I think this is the final economic indicator that I follow very, very closely, and we follow very closely at Evergreen, is corporate credit spreads. So the difference between what corporate bonds yield and treasuries. And this has been a phenomenal recession indicator over time. Currently, you're very tight on credit spreads, which means corporations can borrow cheaply relative to treasuries. And we're also at a very tight level relative to history, which would indicate really not a lot of stress in the economy and corporate America. And this is one that is a real-time indicator. It's not backwards looking. It's based on current yields, current investors, and it is signaling no landing currently. Moving on to the markets a little bit, this one just shows price to earnings on the S&P 500, and it shows trailing at 26.6, 2024, which is almost in the books at 24 times earnings, and then forward 1 year at 21.25. And then it also shows 2026 price to earnings multiple as well. And what you can see is we're at a very expensive absolute level, not the most expensive over time, but definitely very pricey relative to history, and one of the most pricier markets we've seen since the late 90s, outside of a brief period during COVID. So multiples currently on equities are very pricey. A lot of the appreciation we've seen in stocks this year has been multiple expansion, a little bit of earnings growth, but most of that move has been from multiple expansion. In terms of the near-term outlook, the rest of the year, this is a seasonality chart of the S&P 500, and essentially it looks at other years where the market has been strong, like this year, like 2024. And you can see that every year on this chart, from this point forward, the market rallied to finish the year. So generally, with an up market through mid-October, you see a strong finish throughout the rest of the year. So it would be my expectation that the markets finish the year strong, like they typically do. However, if you look at what happens the following year, and this would be 2014, 2018, and 2020, and then also 2022. So the year following those strong years over the last 20 years, the average peak to trough decline that following year was 21.4%. So of course you had the really tough 2022. 2020 had the 30% plus pullback during COVID. Even 2018 had a pretty big pullback as well. 2014 not as much, and that's one thing you could point to in 2014 was multiples were a lot cheaper. We were earlier in the cycle. But overall, the returns tend to be lower that next year. So I'd certainly look to brace for some volatility as we head into the next year or two. And this one from JP Morgan is a really interesting chart. Then I'll pass it back to you, Adam and Dave. But this essentially shows forward-looking returns on the S&P 500 when you're starting at a forward multiple of 21.5 times. And it essentially shows that the typical return is just above zero. It's only a couple, 2 to 3% per year. Now, on a one-year basis, the predictive ability of valuation is very weak. And that's what kind of the left chart shows, while the chart on the right, you can see those results are much more closely tied to that line of best fit. So on a 5-year basis, I think it's, very realistic to assume forward-looking returns on the S&P are going to be a lot lower than they've been over the last decade. So there's reasons to be cautious. The momentum is very strong in the market right now, and the market likes momentum. But I'd be a little bit cautious here on asset allocation from the standpoint of where we are on a starting basis from a valuation perspective.
All right. It's been fantastic. Real quick, the chart that you were just on, that scatter chart there, I don't know if you can easily pull it back up or not. Yeah. So what you're saying is in the right-hand chart where we have more predictive power, the current data is saying we're sort of staring, looks like we're staring at a lost half decade ahead of us, return-wise.
Yes, exactly. And now I think you could, have a couple counterpoints to that. One, there haven't been that many instances where the market multiple is this high. So, and a lot of these are, the same periods. So the late 90s is a good example of that, but there haven't been that many instances of this. So I would take it with a grain of salt, but there's been a lot more good news priced into this market at this point. And I would expect you're going to really need to start to see earnings come through, and the market growth from here on out is going to be far less driven by multiple expansion, in my opinion. And it's going to take more fundamentals to drive the market forward.
Got it. And one of the reasons why I paused you on this is I've had other folks on the channel here put up similar charts, notably from folks like John Hussman, who has sort of a similar style chart where his model basically says for the next, I think it's 12 years, the expected return, I think, is actually negative. I want to say it's like -4 or 5% or something like that last time I saw it. And again, this is, we're talking probabilities here, so nothing's set in stone. And even if this is true, it's probably not going to be 0% return for 5 years in a row. There's probably going to be a lot of volatility in there, some good years, some horrible years, but averaged out over 5 years, to a meager return. But I just wanted to flag that make sure folks took away the right lesson from this chart, but also to mention that there are some other similar charts by other analysts that echo with similar sentiment.
Yeah, no, that's a great point. And then one more chart I wanted to show was bond yields. And I know we're going to talk about bonds and income quite a bit throughout the presentation, but if you look at bonds, on the other hand, valuations are about the most attractive they've been over the last decade. Not the most, about in late 2023, even earlier this year, yields were a bit higher. But for a very long time, this chart shows the 5-year Treasury yield, agency government-backed mortgage yields, BBB rated investment grade corporate bond yields, and we're at the upper end of the range. So you're able to build a bond portfolio a high grade bond portfolio with a 5% yield, you can even include some other areas and goose that yield a little bit, but that's an attractive rate of return relative to history. And especially when you compare the valuation on equities being as high as they are, bonds look pretty attractive here, despite the fact that yields have compressed a bit over the last, 3 or 4 months.
Okay, so stocks looking rich here, richly priced here, bonds looking attractively priced here.
Yeah, I would say that, bonds are they were a bit overbought. Yields have bounced a little bit here lately. So it's all relative. I'd say on a long-term basis, bond yields are very attractive. On a near-term basis, I wouldn't expect significant compression over the next few months, but still it's a good entry point long-term, I would say, on bonds.
Great. All right. Well, look, let's pass the baton to Mr. Hay here. David, is there anything in particular that you would add on to what Jeff has eased us
I
into
know I'm
the
going to
story here
shock
with
you,
this?
but absolutely. So Jeff, can you crank back a few slides to the one that had before the scatter plot and the one before that showed what happens after these two big years, where it shows the negative year?
Yep.
Yeah, two more. Yeah, there you go. And so that's, I don't think very many people are talking about this one. Certainly I don't hear that on CNBC. But then if you look at the next one, isn't that the one that shows the end of the year? Or maybe I've got it backwards. Maybe it's the one before that.
Yep. Here you go.
So what I think is interesting about these, Adam, is they're quite consistent actually with some of the people you've had on. And like Jeff, I'm a voracious consumer of your podcast. I just think they're outstanding, and the people you get on are, really first rate. And when I'm referring to people, I'm referring to specifically are Michael Howell, who you just had on, and Darius Dale, who you've had, not as recently, but a couple of times. And this is kind of what they're saying, really, is that you're likely to have a strong near-term market performance because of momentum, because of the enormous amount of liquidity that's in the system. Jeff had talked about and had a graph there showing, or an image showing the Fed's easiness, financial conditions. Goldman Sachs financial conditions is about as easy as it's ever been. And that's despite all the Fed tightening that's happened. So, and as Michael Howell brought up, you've got the Fed's checking account, the TGA, with about 600 billion of excess. He seemed to believe quite firmly they're going to be releasing that into the system on a near-term basis. And so you've got this kind of odd situation, not completely foreign. I remember being much like this in the late 90s, where you had extreme overvaluation combined with tremendous amount of momentum and liquidity. Back then, if you remember, you're old enough to remember Y2K and the Fed's fears about Y2K. So they flooded the system with liquidity, even though the economy was strong and the NASDAQ was going ballistic, and, it led to a blow off top. And I think that's why both of these could turn out to be pretty accurate. A nice surge here through the end of the year, and then look out below in next year. And I would also say that I don't think we've ever seen as the kinds of geopolitical threats that we've got, at least since maybe the 1930s, that we're facing right now. And I'm not saying they're as bad as the 1930s, but they're pretty scary. And I don't know whether we're going to talk geopolitics. I guess I could just touch on that briefly, because I know you're also a fan of Bloomberg. And I don't know if you saw the recent Bloomberg piece on Taiwan and Taiwan's energy vulnerability. But I think because we kind of hear this binary approach towards Taiwan, which is from, say, Louis Gobb, no way will China invade. Other people saying, yeah, they're getting ready to invade. And it could be the third scenario, which is they don't invade, but they blockade. And that could be very surprising and traumatic to the market. So, probably won't happen, but, then there's also Ukraine, Russia, there's Israel, Iran. I mean, there's things out there that we just haven't seen. And the fact that they're occurring sequentially or simultaneously is pretty disturbing, I think. But anyway, so let's go to my lead in, Jeff. I think this is just really good to look at. So the Economist has had the unfortunate history of running these things at exactly the wrong time. I mean, all mass media publications are somewhat vulnerable to this, but there's nobody that's been able to pull off the timing as horribly as embarrassingly as the Economist has. So
they do. There is the curse of the Economist cover. Yeah,
it is. So this makes me worry about. I mean, when you see that, you're well aware of these statistics, that the U.S. is about 25% of GDP. And yet, I see a little bit of variation, whether it's 65 or 70% of global market cap, but it's just a phenomenal amount of concentration into US equities. So that would be a reason to be concerned longer term. This doesn't necessarily happen day after tomorrow, but I've noticed their cover stories often over 6 months tend to, flip the wrong way for them. So then let's take a look at our next one, which really is, Jeff was kind of getting into this. He had a good slide about 6.5% deficits to GDP, which is just unprecedented outside of, severe recessions or depressions. And what's happened here recently is that the government outlays in the last 3 months are up 35%. Now, that's not the deficit. This is just government spending, but that's creating a tremendous amount of stimulus. So this gets back to that liquidity tidal wave that I was talking about earlier. And it also, I think, really calls into question how superior the US economy is once you adjust for this. I mean, I don't have this visual, but I'll just tell you that if you look at the amount of stimulus of basically deficit spending that the US has done since COVID, it's 25% in the US. If you look at France, it's 9.6, Germany 13.6. I mean, basically the next highest was Japan at 16.5. So we are deficit spending like no other G7 country or developed country. So I think it's way too early to be doing a victory dance and saying, hey, look, we've got a soft landing. Well, let's see what happens once we finally normalize the deficit spending. And you listen to the candidates, as you well know, and I think I've got a slide. Let's go to the next one, please, Jeff. This is related to that. I think Lacey Hunt has talked about this with you, Adam. He's a big one on this, that we have negative national savings. It's just unbelievable. So these tie together, obviously, the deficit spending with this. But again, this is completely unsustainable. And as Herb Stein once said, if something can't continue, it'll stop. And I can't think of anything that's less sustainable than this. All right, we'll go one more here. So the election. And at this point, and I know these things could be distorted. I think this is debating, and there's a belief that somehow some Trump supporters are getting in there and flooding that with money. 30 million, I guess, has been placed on him recently to try to distort the odds, or maybe they just want to win. That's what they believe. But my point really is, from an economic standpoint, I don't know that there's a huge amount of difference between the two. Geopolitically, you could say radically different, but you listen to them and it's a bidding war to see who wants to put out the most goodies that, of course, are completely unfunded. Now, obviously, Harris does want to raise taxes. And so the deficits, the projected deficits look worse under Trump than they do on Harris, but those aren't dynamically scored as far as they typically aren't, and I don't think they are. So when you raise taxes, that can have a negative impact on the economy.
On growth,
which can then, hurt tax revenues. So neither one of them has any concern about the federal deficit. So if there's going to be a wake-up call, putting aside some kind of geopolitical trauma, I think it's going to be in the bond market, the long end of the Treasury market. And as Jeff says, if you look at the corporate bond market, it's acting very well behaved. Yet you look at that 10-year Treasury, and it got hit again today. It's up 60 basis points from where it was when the Fed cut. That it's telling us, I believe, that the Luke Gromen thesis is that we've got problems with the longer-term part of the Treasury market is right. There's tremendous demand, as you and I've talked about before, for short T-bills. But you get out there to 7, 8, 10, especially beyond that, and that market's very illiquid and very fragile. So again, if there's going to be a wake-up call coming soon, I think it's going to be because of the long U.S. Treasury market.
All right. Well, David, look, you have connected a lot of dots for regular viewers of this channel, because you've touched on a number of things that different experts have said in relatively recent history on this channel. We just had our conference this past weekend, so I've actually got the fresh words of folks like Lacey Hunt and Darius Dale and others in my mind here. I spent a fair amount of time this past weekend actually talking with Lance Roberts about credit spreads. And I guess first I just want to ask you your concerns about the long end of the Treasury curve, the mid and long end of the Treasury curve, I think are shared by people. Why do you think credit spreads are so tight right now? Right, we've got a big bond market. I mean, the Treasury market's huge. A big bond market is actually on the move with higher yields. but it's not getting, we're not seeing any signs of any concern in credit spreads yet.
Well, I'm glad you asked that. I'm smiling because I wanted to bring that up. And, from what Jeff pointed out, you could say, well, it's the Goldilocks or no landing, scenario is being voted as the winner. As you're aware, this has been an intense debate for a couple of years among those who thought hard landing, no landing, soft landing. And there's been times it looked like the hard landing people would come out on top. And right now, it certainly looks like the soft no landing group is in charge. So I think that's part of it. But I will throw out another reason, which is I'm thinking that the bond market, both corporate and treasury, is starting to sniff out that corporate credit may be better than US government credit. That this is becoming more of an emerging market type of bond market, where the profligate US government is in much weaker condition, obviously, than the corporate sector, which termed out its death. I mean, that's another amazing thing is when we had the 10-year treasury down at 0.55%, basically 0.5% in the summer of 2020. And it stayed low for a long, didn't stay quite that low, but it stayed 1% for a long time. The treasury did not term out the debt. They didn't extend maturities. They
Right.
stayed very, very short. Whereas the corporate world and people with their mortgages, they said, hey, this is a phenomenal opportunity to go long. Why didn't they do that? I think that tells you that even then, the powers that be realized the fragility at the long end of the curve, and that they really couldn't do it without, maybe setting off some alarm bells. So it could be that we're in this period where the spreads are going to grind lower and lower. And I also think, and I've talked about this before, that one of my craziest forecasts of all time, which Jeff vividly remembers, was when I was saying in the late 2010s that I thought in the next crisis, which turned out to be COVID, that the Fed was actually going to buy corporate bonds, which was illegal. But of course, they created a workaround for it. So I think that there's this, we talk about the Fed put in terms of the equity market, but what about the Fed put in terms of the corporate bond market? So I think it's, as usual, it's a multi-factor thing, but I kind of think that second factor might be the most important of all.
That's really interesting. It opens a number of doors. I don't know if I have time to go in with you, but is, how the crisis playbook has changed post-COVID, right? There's so many things we did during COVID that nobody could have imagined before. Are they just now going to be the regular playbook going forward every time the market, the economy gets a little rocky? I don't know. I know a lot of people think it will be. Let me ask you this though. So the reason why I'm spending so much time on credit spreads is, as Jeff said, and then David echoed, the veterans really look at that as an early indicator, sort of a canary in the coal mine, early indicator of growing concern in the bond market. And they haven't moved, like I said, right? And so it could be a new world, David, as you're saying, that just, hey, that indicator operates differently now post-COVID than it did before. Everything you said made sense to me, but let me just ask you this. If you look at the corporate credit spreads between high yield debt and corporate credit, those haven't blown out at all. And I can understand, yeah, maybe a large multinational that's super rich in cash, like a Google or an Apple or an Amazon, yeah, maybe their debt is preferable to treasuries at this point in time. But I can't imagine that the bond market's ready to take high yield credit as, safer than treasuries. So how come we're not seeing those spreads between the high yield and investment grade corporates widen yet?
I think it comes down to the B word, which I know a lot of your guests have used, bifurcation. There is a lot of bifurcation, including in the corporate bond market. So Jeff knows this better than I do, but I believe triple C, so that, right above the default level of junk bonds last year hit 16%. And they've come in for sure, but he can check and tell me where they are right now. I think they're still solidly in the teens. And then if you look at like floating rate debt in the private credit world, those are still kind of in the 9, 10, 11% zone. So it's a situation where, just like with weak consumers, weak corporate borrowers are having to pay through the nose. So it depends on what part of the bond market you're talking about.
Yeah, I guess I could be wrong, but I'm pretty sure that the data I saw this weekend, and again, correct me if I'm wrong, was just showing, spreads over time between high yield and investment grade. And whatever the spread was, it was still tight and or tightening versus widening.
For sure. Now, part of it is Jeff knows better than I do that the double Bs are a much bigger part of the junk bond market than they used to be. And those are high quality. They have very low default rates, like historically 1%. They tend to have the best risk adjusted returns. But Jeff, we're at triple Cs right now.
11.8% yield.
So about 12. That's down a lot. They were 16, but that's that's up there. But again, they have very high default rates, especially when you get into recession. So, but it's not just triple Cs. It's that private credit market, which, as you know, is enormous, and those borrowers aren't paying 6 or 7%. I can guarantee you. So it's a tale of two bond markets. Jeff's heard me say this so many times. It's a tale of two. Insert whatever. So it's guess maybe be careful with averages, and you have to kind of drill down and see the granular facts underneath it.
Okay. I
But,
guess
Adam,
I'll
if I
ask
could
this
just make
question
one
one
point.
last way, and then I'll let you guys, we can move on. But I would think that we would see credit yields begin to blow out between high yield credit and investment grade credit, perhaps before we saw credit yields blow out between the general corporate credit market and US Treasuries. And so I'm just asking, are we seeing any signs of warning right now in that high yield versus investment grade credit? Because I haven't heard that we are yet.
No, I'm not
Well,
seeing anything. And
I think you're right.
a little bit in the triple C market. You've seen a little stress there, but I think, you had quite a few downgrades from investment grade to high yield, fallen angels in 2020. So I think the high yield, my belief is that the high yield index is higher quality than it's been historically. However, at plus 318, high yield is not very attractive. We like to buy high yield when it gets over 500 into the plus 7, plus 800 zone. So at Evergreen, we've been lining up quite a bit on our high yield exposure with a focus almost entirely on that double B space, which, as Dave mentioned, from a risk adjusted return perspective, double Bs have outperformed higher rated credit and lower rated credit over time. So it's the best return segment of the credit markets, of the corporate credit market, I should say. So that's the area where we're focusing on, but we have lightened up quite a bit within the high yield portfolio.
Okay. Where I guess where I'm going with this is, credit spreads again are sort of their early warning indicator. They are not going off. The credit spread canary is still looking hale and healthy and singing in its cage. And yet we have some of these concerns, right, that you mentioned, Dave. And maybe it is, hey, we're in Goldilocks right now, and people just think we don't need to worry until it looks like Goldilocks is getting ready to leave the party. I did hear from Darius, like I said, just a couple of days ago, and his model has us firmly in Goldilocks, and until he sees signs otherwise, he's long right now. So maybe that just is the market, but I'm just curious because the data you showed suggests that even if we have a really strong end of the year, there's precedent that says the following year for years like this one, they tend to be pretty painful. I mean, down over 20% on average is a scary number. It doesn't seem like the market's placing any discount, yet on that, except if you want to look at the rising long duration US Treasury yields, that could be an example. And if it is, again, it just makes me scratch my head. Then how come credit spreads aren't reacting yet?
Yeah, well, again, I guess, Jeff, you said right now overall high yield was 380. Is that right? 380 over. So
318.
I'm sorry, 318, even narrower. So what that means in English is that the typical high yield bond is paying a little over 3% more than a treasury bond. But yet the triple C is 11.8 over. So, well, I'm sorry, not over. That's gross yield, 11.8. So you would say that that's what, almost 800 basis points over, 8% over treasuries right now. That's a pretty big spread in that part of the market. So I think what it's telling us is that while overall corporate credit is fine, there are pockets of stress in the lower quality parts of the high yield market. And I think that's also true in the private credit market. And it's obviously true with the lower end consumer. I mean, the lower end consumer is not doing well right now. And you've seen the data. Probably don't have to worry. You know how big the credit card debt is. It's well over $1 trillion. What's the interest rate's like 22% on that. You're
Right.
seeing personal
Delinquencies are going
bankruptcies.
up, personal bankruptcies are
Uh,
going up. Yeah, all that. And again, sorry, and I don't want to be beating a dead horse here, but like, uh, so if there are pockets in the high yield credit market where you're seeing those big differentials you're talking about, are we seeing any contagion spreading yet, or is it not? Because it doesn't seem like we are. Like
no,
you and I can point to a ton of issues, consumer or whatever, but it doesn't seem that at the core of the system where risk tends to first manifest and then spread is flashing any warning signs yet.
at the risk of sounding like Ben Bernanke, I think the problems here are contained in the subprime part of the bond market and the corporate borrowing market and the consumer market. I think for
Okay.
now they're contained, and I don't see the trigger that's going to make them go viral. I think corporate America is in actually quite good shape. So it's not surprising that you're seeing this the separation between the majority that have very healthy fundamentals and the minority that don't. So I think that's kind of a good news situation, and I'm trying not to be a Pollyanna, as you know, I'm far from that, but I think that's just real reality.
Okay. So, I'm trying to resist going into, because David, I can detect maybe the concern, the worry in your voice for this bifurcated structure. Like it doesn't serve the economy to have the wealth continuing to concentrate at the top and more people, falling out of prosperity. Um, it sounds like you guys have concerns about rich valuations in the equity markets. And then maybe, who knows what's going to happen in the bond market going from here. But from what I hear you saying is, but actually, looking on the average, things aren't that bad. And we as capital managers have to get out there and, we got to deliver returns for our clients. So I want to talk in a moment about how you're doing that. And I sense, and I could be wrong, but I sense that you see a better opportunity, perhaps than we've had many times in past decades, to develop a really attractive income generating portfolio, which might actually be a good shield if equity ends up having a bad couple of years going forward. Let's talk about that, but real quickly before we do, let me just ask you this question, and David or Jeff, whoever wants to take it can take it, is um, while you're right, David, the conditions ended up easing over the course of this tightening regime that the Fed's been on. The Fed did hike interest rates more aggressively than kind of in living memory, right? And many people, and I'm definitely one of them, warned about lag effects, right, of all this. And to a lot of people, when they hear things like, yeah, actually, corporate America is actually looking pretty good, and we think it's, going to be Goldilocks for a while, like, did we avoid the lag effect this time? Like, did we almost kind of get, I don't want to say a free lunch, because definitely the purchasing power of our currency took a big hit over the past 4 years. But did we kind of make it through all the craziness that we did with all the extraordinary, unprecedented measures that we did through COVID? Are we managing to get through this without having to really pay the piper?
Go ahead, Jeff. Sounds like right up your alley.
Well, so far, I would say the answer to that's yes. However, I think the long-term ramifications of all of the spending we have done is going to have a negative impact on growth. But so far, it looks like the answer is yes. And I think a part of that is the fact that corporate America termed out their debt. The consumers termed out their debt as well. 65% of households own a home. And when you have a fixed mortgage rate at 2, 3, maybe 4%, you're not getting hit as hard when interest rates go up. Of course, the consumers that are renting, the lower end consumer that has credit card debt, or that a larger chunk of their budget goes to, essential items where prices are going up at a fast clip. For sure, that area of the consumer has gotten hit very hard, but for the large majority of consumers and corporations, I think they're in pretty good shape right now.
Okay.
Adam, can I just interject one thing
Please
related to
do. Please do.
So I think also what we forget, because we're human beings and we tend to have a recency bias, is how bad 2022 was. I mean, that was a wicked year. I mean, it was, as you know, the worst year for balanced portfolios in over 150 years. I think Ulysses S. Grant was president the last time that a balanced portfolio, I don't know how they tracked it back there, but apparently they did that poorly. And the other thing is that it was an absolute annihilation for what I have been calling in 2021, the crazy overpriced stocks or the cops. I mean, those things went down 70 to 80% or 90%. So we forget what a bloodbath that was. And spreads did widen out significantly. And we did a lot of buying of corporate bonds in the summer and fall of 2022. And I believe the high yield spreads got to 600 basis points, 6 full percentage points. And a lot of those have had equity like, well, normal equity like returns, not so much returns in this equity market, which have been so extraordinary. So there was a lot of pain at that point, and there'll be pain again. And that's what has kind of struck me from listening to Darius Dale and Michael Howell, especially Michael, as I listened to twice to that recording you did with him, where he's saying, yeah, there's all this liquidity, but boy, watch out next year and the year after. And part of it is this maturity wall, which I think not many people are focusing on. This $50 trillion.
I was just about to ask you about that. So please, yeah, whatever thoughts you have on that, share, because yeah,
Again,
that's what Michael Howell thinks is going to end the party here.
Well, it certainly could. And where it's most likely to be a problem is on the weaker credits. So I don't think that maturity wall is going to matter at all to the strong credits in the United States. But as far as, somebody that's a single B, borderline, triple C, those guys could go under. And as it starts to, so far it is contained. Again, I don't want to sound like Bernanke, but it is. Could it spread? Yes, it could spread. And that certainly could be one of the triggers to do it. But I think what's also interesting about almost everybody I hear you have on, they bring up the fourth turning. And I'm absolutely a believer that we're in the middle innings of the fourth turning. And those typically bring at their conclusion very bad bear markets. They tend to have a lot of inflation. Of course, we've had a lot of inflation. Will we have more inflation in the future? I tend to believe we will. I think that's the way the government gets out of, the condition that they're in. And there's just no way we can service our debt from a federal standpoint. Again, corporate America, much better, which could be, again, behind that spread contraction. So I think it's important that, maybe this is a good time to talk about some of the, if you're an income investor and you believe we're in the fourth turning, what do you do?
Great. So let's go into there. And just to make sure I'm painting the right context here, correct anything I'm about to say. But again, listening to you guys, it sounds like I took it as a reminder that the financial markets and the economy are two different things. Right. A lot of people kind of equate them. And, Jeff, looking at your charts there, it sounds like, hey, for the time being, economy's growing at 3% GDP a quarter. You don't see a hard landing, in the headlights of the car right now, as far as your model can see right now. So it just looks like, yeah, for all intents and purposes, looks like we've made it through for at least the foreseeable future. Whereas when you look at, say, the stock market, you can say, yeah, multiples are looking really rich here. And of course, you shared the chart that showed that, wouldn't surprise you if returns kind of go nowhere on average for the next 5 years, right? So that just valuations alone in the equity space suggest, hey, bonds might be a better bet going forward, especially as you said, they're fairly attractively priced relatively. Now, to Dave's point, if the Michael Howells of the world are correct, and this wave of debt refinancings that's coming next year really does start to drain this liquidity that's been powering everything higher in this current liquidity cycle that's been going on for the past 2 years or so, then that actually might have impact not just on financial markets, but also on the economy as well. Like that's something that could slow us enough to maybe make a recession possible. And the reason why I give all that context is if you're worried about both those things, equity valuation risk and midterm economic risk, an income-based portfolio of credit instruments actually begins to sound really pretty attractive, right? You're nodding as I'm saying this, Jeff, and I'll say one last thing and I'll shut up and let you guys go. But Stephen Bavaria, who I've had on the program a couple of times, designer of the Income Factory, and helps people build income-generating portfolios. He, I think, feels similar to you guys about both the equity risk side of things and the macroeconomic risk. And he says, I really like bonds in environments like this because all you really have to worry about is the existential risk of the company. The company just needs to stay alive. And if it does, it'll pay you because that's the contract of your bond, right? And even if it gets into trouble, if it's, you've got a senior claim as a creditor versus the equity holders, right? Whereas if you're in equities in an environment like this, you already have the existential risk. If the company goes out of business, you lose everything. But then you have all sorts of other risks on top of that. You've got the entrepreneurial risk. You've got the market valuation risk. You've got the fact that you're a subjugated. You've got subjugated claims if the company gets into trouble. So there's just all this more risk layered on top of the equity side. So it seems to me you can make a pretty good argument that this is a really good time to be considering building an income generating portfolio. Do you guys feel the same way?
I guess I'll go first. Yeah, I would say yes, but not all bonds are created equal. And
Absolutely.
not all bond management styles are created equal as well. And if you go back from 1999 to 2019, the Barclays Ag annualized 5% per year. For most of that time frame, bonds had a negative correlation to equities. So when stocks went down, bonds went up, added the diversification benefits, protection to the portfolio, and then had a pretty respectable 5% return. So for the most part, you could set it, forget it. You could be a passive income investor and be just fine. That has completely changed in recent history. Over the last 5 years, the ag has returned just 0.33%. The real return after inflation, much worse, of course. Vanguard total bond market up just 0.35%. TLT, long-term treasuries, down 5% per year over the last 5 years. And then not only
That's
that,
that's in nominal terms, right? That's not adjusted for inflation.
Yeah, that's the nominal terms. And then you also had this increased correlation between stocks and bonds. In 2022, as you mentioned, Dave, the S&P was down 18% and the Barclays Ag was down 13%. And I did mention, I think inflation is going to trend lower over the next 6 months, but inflation expectations, meanwhile, the 5 and the 10-year inflation expectations have started to head higher. So I think it's very likely you're going to be above 2% going forward than being below 2%. So you don't want to just hold long-term bonds and have a static approach. You want to have a diversified portfolio of income generating securities that include inflationary beneficiaries like energy infrastructure stocks. You want to have an active approach where you're changing your duration based on the yield environment. So when yields got really low a few years back in 2021, you wanted to be really short on the curve. As they moved higher, you wanted to extend your duration. Same thing on credit. When credit spreads are tight, you want to avoid the junkier parts of the credit universe. When they widen out, you want to be adding to those areas. Currently, you might want to hold a little bit more in the government backed bond segment, mortgage-backed securities, even intermediate treasuries. So making those changes over time can add a lot of return, but also you want to incorporate other areas. As rates have gone up, incorporating some REITs, adding some dividend-paying stocks when markets correct. All of that can add return. But I think it is an overall attractive environment where you can build out a pretty high quality bond portfolio that yields over 5% and then incorporates some inflation protection as well.
So
Great.
Adam, if I can chime in, he said
Please
something
do.
important there, active. So as you know, in the equity world, active has gotten a very bad name because active managers have underperformed, during this raging bull market. And the money has flowed drastically from active to passive. Will it flow back at some point? I think it will, but it's a pretty deep hole. Whereas you probably have seen Barron's had a big article on this recently that in the bond world, active managers have fared much better. And you've seen our numbers. You've seen our return numbers. And
I have. They are very impressive, just FYI. I mean, I'm fairly shocked how well you guys have done in that.
Well, thank you.
And kudos to you and your team.
Well, and a lot of that goes to Jeff. Absolutely, with no exaggeration. And this last 5 years, as you mentioned, has been tough. And Barron's had an article that one of the best performing bond fund. Ironically, it wasn't my hero Jeff Gunlock, but it was Carolyn Reams, which I really don't even know. But their 5-year return was 2.4. That was the best. Now that is an annualized. I'm sorry, that is an annual return, right, Jeff? The article was a little confusing the way it was written, but suffice to say, I don't want to get real specific here, but our return over that period of time was substantially better than that. Substantially. So, and it's that particular strategy we call principal preservation has been around for almost 8 years now. Jeff, is that right?
Yep.
And our income replacement, which is, so that's an important point because so often people think about trying to minimize principal volatility, not just with stocks, but with income and bonds specifically. When people think income, they think bonds. Well, that's not necessarily true. Jeff just rattled off a number of things like REITs and pipelines that provide nice cash flow, but they tend to be more volatile, at least price-wise. But what's interesting is they tend to be less volatile from an income standpoint. So just think about the 10 years from 2010 to 2020. If you were a bond investor and you were just rolling your bonds over periodically, that you didn't have 30-year bonds, your income just got destroyed because of that collapse in interest rates.
Mm-hmm.
And that, I think, gets overlooked. This sense that if you're a retiree and you really need dependable cash flow, we would argue you should be more concerned about the stability of your income than the stability of your principal. And that's not to say that principal doesn't matter, but some degree of volatility is okay, especially if your manager is proving the ability to take advantage of that volatility.
Sorry to interject, but I want you just to incorporate this in the rest of your answer. So, the average or the age of the average viewer of this channel is, I think, 2/3 are 45 years and older, and there's a healthy amount of retirees. So basically, there's a lot of people watching for whom income matters, retirement income matters, and we are we're now fairly well into the T-bill and chill trade, which may now have a timer on it, right? An expiration timer on it, with the Fed saying, "Hey, we're now cutting rates," right? So one of the questions these people are faced with is, what do I do, right? Do I just stay in the short end of the curve and do I just ride this down? And hey, it was nice while it was around. Do I try to push out for further duration here? Do I move it into equities or other types of investments? So it's a real timely question that they're asking here, and the type of strategy that you're talking about, I believe, and correct me if I'm wrong, it's a way to say, hey, if you like income and you still have a relatively conservative bent, definitely try to consider the type of actively managed approach that you're describing, because it might be able to give you, equivalent or probably higher rates than what you were getting in T-bill and chill with not much additional risk. Correct?
Correct. And let me give you one example now. This is in the context of a diversified portfolio, because if you only buy one bond, then you are taking a lot more risk than a
Absolutely.
T-bill.
Yeah.
But we typically put in 1% of a portfolio value into a position that's not a treasury or government backed. Sometimes it's only 75 basis points. But just one example is a bond issued by a major Hollywood. We used to be a major Hollywood studio. They don't even make films anymore. They're the casino operator, one of the big casino and hotel operators in the country.
And great write-up about this in your latest Haymaker, by the way.
You saw that one, okay.
Yeah.
I have to be a little careful with mentioning individual names, although I guess we can do that in this particular setting. But suffice to say that it's double B minus rated, so it's in that low end of the double B category that we like so much. We think it's underappreciated. I mean, they've got quite a bit of cash, they've got a lot of free cash flow, and it's yielding 6%, 6.15, I believe, to its call in 2029. 2029, and its final maturity is 2033, where it yields about 6.25. That's a little longer than a lot of our bonds. A lot of our bonds are more like in the late 20s. But one of the advantages, which I think people forget about when it comes to bonds, is an effect known as seasoning. And by that, I mean, if you buy a 6-year bond today, and in 2 years, let's say interest rates have gone up, your bond's only got 4 years to go. So it's become a shorter maturity. And you can, for most of us, and I'm going to be 69 in 9 days. So even for me, I can hold these things to maturity. Life expectancies are accurate. So that's an advantage of, we call it riding the yield curve, where you buy these longer maturities, but they're not, if you're buying a 30-year bond in 10 years, it's still going to be a 20-year bond. You're not going to get the benefit of the seasoning or the shortening. Mm-hmm. But if you're buying a 6 or 7-year bond, that's a big positive. And it's critical, Adam, that it works with individual securities. When you're buying bond funds, which so many of our competitors do, they're just constantly rolling. So you don't get that. You don't have that hard maturity date.
Right.
So that's a big advantage, I think, when it comes to buying individual bonds. The problem is, for the average do-it-yourself investor who has no trouble buying NVIDIA and other equities, it's really hard to buy bonds, literally from a logistical standpoint. So I would really encourage most of your people to be looking at active managers. We're certainly not the only one out there, but we're one of the few that runs these individualized portfolios where you can actually say, okay, clients can specify, I don't want to have any long bonds. I want to, stay intermediate. Now, obviously we can do more customization for larger clients and smaller clients, but I think that's a big advantage in the world of fixed income.
All right, let me just contrast one thing here for folks. So I mentioned Stephen Bavaria. I'm guessing a lot of the viewers of this video recall the discussions with him. Stephen, he basically has a newsletter service that he publishes where he has sort of his own portfolio that he transparently shares with his subscribers and says, okay, look, I bought this fund for this reason today at this price. If you want to follow me, fine. If you don't, that's fine too. And he builds his income factory. He does buy funds. He doesn't buy individual bonds, probably for the exact reasons that you mentioned there, David. And if you're a DIY guy and you like that approach, I think super highly of Stephen, and I think it's great if you decide to go work with him. I see firms like yours kind of offering the non-DIY investor the same benefits and then some additional ones, to your point of you guys have the ability to buy individual bonds, and so you can do the seasoning and things that you can't do if you're just working with funds alone, and you're kind of taking over the role of financial quarterback for the person, at least for managing this. I'm going to call it this income portfolio strategy. I don't want to say bonds because it's just not specifically bonds. I know it's a whole bunch of things, REITs, energy infrastructure stocks, like you guys talked about, corporate bonds, CLOs, all sorts of different things. So anyways, I just, for the viewer, if you're super self-directed, maybe go check out Stephen. If you really like this concept, but you don't want to be doing it all yourself, a firm like Evergreen Capital could be a really good firm to talk to.
And just to be clear, we do have a dedicated bond strategy that we call principal preservation. We even got a cash management strategy, which typically is for very wealthy people. So we do have pure bond strategies, but I think it's actually better usually for people to have more of the diversified income, what we call income replacement approach. And I also want to point out that just to set expectations properly, to have a really diversified, individualized bond portfolio, it takes a fair amount of capital. Jeff, is $1 million kind of the reasonable amount for one of those? Yep. Now, for somebody who's got less, we use ETFs. Now, you lose some of the benefits we just talked about, but we've shown a pretty good ability to extend duration at good times and to, as Jeff said, take on more credit risk or less credit risk at opportune times. And we can even use some of the midstream and REITs in there. And so we do have it's not just for rich people. Basically, we can definitely handle some normal folks as well.
All right, good. Well, look, gentlemen, we are coming up on the hour, and I'm looking at the pages and pages of notes and talking points we had here, and I'm sorry we didn't get a chance to get to all of them, but that's a sign of a great conversation as we hit a rich vein early on. Is there anything else, either about the macro and market world or about the specifics of income investing that you think are critical to share with the viewers before we start getting to the conclusion part of this discussion?
Yeah, I think so, because I know you had Louis on it. I don't know if this came up with him, but it's hardly talked about. We haven't talked about it yet today, and I think it's one of the biggest opportunities for income investors, and that's with emerging market debt. Because there's such a bias from developed world investors, particularly Americans, to look down upon, say, countries like Brazil or Indonesia or Mexico or, for good reason, Argentina. But I think even with Argentina, there's some really interesting things going on. I guess the macro view here of emerging markets is when you look at them collectively, their government debt levels are about half of what they are in the US and the rest of the developed world. They have actually been following much more of the monetary and fiscal policies that we used to do during our proud days that we've moved away from, and we've become more emerging market-like. So in Brazil right now, the 10-year government bond yield's 12%, and the inflation rate's running about 5%. So you've got about a 7% real interest rate.
Wow.
Now that's an extreme one, but there's a number of other countries out there that have got, 3, 4, 5% real interest rates. So, and there are a number, this is a really hard area even for us to buy, say government bonds from Brazil, but there are closed-end funds out there that we have been involved with for a number of years that are reasonable ways to play it. They're not perfect. It's a frustrating area in that regard, but these things are trading at discounts from their net asset value, and you get paid on their, the full market value. So there's kind of that advantage. But I think in general, emerging market debt it has been outperforming. It has drastically outperformed US Treasuries in recent years, and I think it will continue to, and yet it gets so little attention among US investors, even institutional investors.
All right. And I'm sorry, I honestly can't remember if that came up in the discussion with Louis. I'm not remembering that it did, but I do recall that when I interviewed a representative from Jeremy Grantham's GMO about a month and a half ago, he echoed very similar results about emerging markets debt. So you've got great company in that opinion there, David. All right, Jeff, on your end, anything else that you want to get on the table here before we start wrapping things up?
Yeah, I would just highlight a few areas we like. Agency mortgage-backed securities look really quite attractive today. The spread's plus 120. That's wider than investment-grade corporate bonds. Investment-grade corporate bonds oftentimes trade 200-300 basis points wide of MBS. We like DMBS, double lines MBS fund. And this is one area where we do buy funds. Just like emerging market debt, MBS is hard to buy, individual securities. So we do use funds for mortgage-backed securities. That particular fund has a 5% SCC yield, which is kind of the current yield after expenses. On the REIT side, we like Mexican REITs as well. Just like Brazil, by the way, on the emerging market debt side, Mexico pays 10% on their 2-year. Inflation's running at 4.5%, so you're getting a 5.5% real yield. But on the Mexican industrial REIT side, you can buy really high quality industrial focused real estate investment trusts that traded under 10 times cash flow. They're paying out distribution yields of around 8.5%. The industrial rents are paid in US dollars. So the weak peso does not have a huge impact on earnings, but the soft peso has an impact on the share price. So the recent weakness is a function of outflows out of Mexico, soft peso, yet the fundamentals remain strong. It also benefits if you get further trade tension from China. Guess what? We're going to do more business with Mexico. Mexico has a cheap labor force. So those look particularly attractive right now. I'd also say midstream energy is one that I'm sure Dave's the resident expert there, but for the position, so this is essential infrastructure stocks in the US on the energy side, pipelines, processing facilities. The sector, a lot of the securities within that segment pay 7 to 8% type distribution yields. There's a tax advantage aspect to that because around 70% roughly, and these do have K1s, that's a negative, but around 70% of the income is return of capital, 30% is ordinary income. So from if you're a taxable investor, you get a nice benefit for current income. There could be a step up over time as well. The return of capital reduces the basis, but that area has performed exceptionally well over the last 4 years, plus 38% per year. It's a very volatile space. The volatility is higher than stocks. But if you go back, and Adam, I know you're well aware of the energy kind of crises we've had over the last decade, but if you go back to 2014 and you invested at the peak for MLPs or midstream energy securities, so like middle of 2014 to today, despite a peak to trough decline of 87% for that market has outperformed the Barclays Ag because of the distribution yields and the recent rebound here recently. Debt levels are down for that space.
Wow.
And cash flows are growing in the 6 to 7% range. These companies have debt levels that are down from 5 times cash flow to around 3, maybe 4 times. And these companies are now buying back shares. So it's a space that's been phenomenal for our investors. You just want to kind of be careful on the entry points. We've been trimming back that space here recently, but we still hold about 10% of our kind of go anywhere income strategy in midstream energy securities. And finally, private credit's also a really attractive asset class for those that can get access to it. We're focusing on top of the capital structure lending in private credit. So first lien lending. We're not doing much on the subordinated side. You can still get yields in the 10 to 12% range. We use partners for those investments primarily, and you want to stick with the best in the business operators within the private credit space, and you want to stay top of the capital structure, as I mentioned.
All right, gentlemen, look, I forgot to say this at the beginning, but my favorite people to interview on this channel are capital managers like yourselves. And the reason for that is you don't have the luxury of just having an opinion on where the markets are headed and how the economy is doing. You actually have to, you know, have the convictions to then apply what you think is going to happen to your capital management strategy. And you have to be answerable to your results, to your clients there. So I appreciate you coming, sharing both your outlooks with us, but also being so generous and sharing the specifics of the types of assets that have your interest most right now. And folks watching, I hope you took really good notes. To me, this is exactly the kind of interview that I love to do, where you're throwing out a lot of different asset classes that you think are worthy of consideration that people can go explore on their own. Now, obviously, a lot of people who do may have a lot of questions about this, especially if they haven't invested in a lot of these assets themselves. If they would like to reach out to you guys or follow you and your work in between today, your appearance here now and your next appearance here on this channel, where should they go? David, we'll start with you.
Well, as you know, Adam, I publish a newsletter, which is actually distinct from Evergreen, though there's naturally a lot of overlap in what we're doing at Evergreen, what I talk about in the newsletter. It's the Haymaker, which for now is at Substack. So that's one way that people can kind of test drive and see if they really like the way we do things, because there's quite a bit of specificity in there, as you know.
And it is a great publication. I just want to be on the record for that. It's great.
Thank you. I appreciate that. So that's one way. And then the Evergreen website. So Evergreen Gavekal, and just a little, we kind of skip over that, assuming everybody knows, but we've talked a lot about Louis Gav. So Louis is our partner. We're really lucky to be partnered with Louis and the incredible macroeconomic research that Gavekal puts out. Almost every major money manager on the planet Earth is a client, of certainly a majority. So they're really good, as you well know. So that helps us a lot. But Jeff, what would you say? How would you? Because you put out, Jeff puts out some really nice, like he just said, the chart book that he does on a regular basis, and I think people could access that. Are they able to on the website?
Yeah, evergreengavekal.com is our website. Within the website, there's a place you can schedule a consultation where we'll analyze your portfolio, do a meeting. There's also a compatibility survey as well if you want to fill out to see if you'd be a good fit as a client. There's a blog, we have a podcast, so you can follow all of those online as well. So just evergreengavekal.com.
All right, fantastic, gentlemen. Folks, if you have really enjoyed this conversation with David and Jeff, would like to see them back on the channel as soon as their schedules allow, please let them know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Just want to remind folks of two things. One, we had the Thoughtful Money Fall Online Conference this past weekend. It was phenomenal. Hopefully you saw my video that I kind of gave some of the top highlights from it. But if you didn't attend and really wish you had, you can still buy the replay video of the entire event by going to thoughtfulmoney.com/conference. And then also on our Substack, our premium subscribers get our Macro Pass service. The Macro Pass for this week is coming from the great David Hay himself. So if you're a premium subscriber, keep your eye out for it. You might have already gotten it by the time this video rolls out. And if you are not a premium subscriber yet, maybe think about becoming one. It's not very expensive at all. All right, with that being said, gentlemen, can't thank you enough. David, I'm going to let you have the last word here.
Well, you're not going to ask me about what is my one non-financial piece of advice I'd give. Well, you're not going to ask me. I'll volunteer it. Pick really good partners like Louis Gav and Jeff Dix, who are a lot younger than you are. That's my one piece of advice. Doesn't matter what business you're in, it works well. Actually, Jamie Dimon said that what his secret to success is he would surround himself with smart young people that would argue with him. And I think that's one reason why Jamie's been so successful. He was never a yes man kind of guy. And I was privileged to work with him back when I was kind of young.
Yeah, so you were one of the people he surrounded himself with. So it's no surprise why he's as successful as he is. If he had access to the young David, hey, are you kidding me?
Well, we're actually about the same age, but he just
that-
seems
that-
like he's a lot smarter.
That's great advice. I think the only thing I would add to that, David, is absolutely do that. But I would also say in your circle also include smart people in general, but some smart people of a generation older than you, so that you can tap their wisdom. And I'm sure in your career, David, you've had a lot of potential pitfalls that you were able to avoid because a mentor took you under their wing and said, "Hey, look, I did what you did before. This is going to happen unless you do X, Y, or Z," right? You're nodding as I'm saying this.
Absolutely.
Yeah. So I like to kind of say, every great company, has a board of directors, a board of advisors. We as individuals should recruit our own board of advisors, right? And get some gray hairs in there that you can benefit from. Get some young, bright and shiny people with a lot of enthusiasm and a willingness to push back. But collectively, they will make you way smarter than just you yourself operating as a lone wolf will be. Great advice. Jeff, super pleasure to meet you, my friend. All right. Well, look, David and Jeff, I'm sure we're going to get lots of great feedback on this video, but I really like the duo here. Would love to have you guys back on the channel as soon as your schedules allow. Everybody else, thanks so much for watching.
Thank you, Adam.
Thanks so much, Adam.